Good morning. This is Jason Dahl again with AFS Financial Group. Happy to be here today to provide today's webinar on insurance planning. Just a few quick kind of housekeeping items. This is being recorded, and we'll be able to share the recording as a follow-up, as well as the slides for anyone who is interested. And then I also just want to point out that during the presentation, if you have any questions or comments, there is a chat feature down at the bottom of your screen. You can just click on that chat. It opens up a little dialog box, and you can type it in. And so we will be on the lookout so if anybody puts in a question or comment. So let's go ahead and get started. So as I mentioned, this is today's presentation on insurance planning, and this presentation is designed to help you better understand how to incorporate insurance into your overall financial plan. And we aim to help you answer questions such as, what risks do I face that could prevent me from achieving my goals for retirement or college funding or paying off debt, as well as what risks could lead to a catastrophic loss for me or my family. And we're also going to help you identify appropriate types and amounts of insurance that you can utilize to transfer some of that risk. I also want to point out right up front here that underlying everything we cover today is the fact that you really do need to work with an experienced insurance professional who is both knowledgeable in the specific types of insurance that you're reviewing, but also, perhaps even more importantly, understands you and your family and your unique needs. Right, because there are a lot of people who can sell you insurance, right? And that's not really the point of today's presentation. The point is, having a process for identifying, oh, do I need insurance? What type of insurance? How much? What can I afford? What fits into my overall financial needs, financial plan, goals, and so on. And so it really is important that you work with somebody who is able to help you at a deeper level there than just selling you insurance. All right. So let's just take a quick look here at today's agenda. It's real simple here. The four common types of insurance that we're going to cover today are life, liability and loss insurance, disability insurance, and long-term care. We will also discuss the concept of self-insuring and when that may or may not be appropriate for you. And I also want to point out that there is one type of very important insurance that we will not cover today, and that is health insurance. Now, everybody needs health insurance, and it really is just a beast in and of itself, and it's kind of beyond the scope of today's conversation, but we obviously recommend that you have it, and for folks who have coverage through their employment, your HR or group plan administrator is usually going to be your best resource for reviewing your health insurance needs. So I just want to point out that we are not going to really dive into that. We'll touch on it a little bit as it relates to long-term care, but that's about it. All right. So I just want to start here with a quick poll, if you will. So hopefully most of you recognize these three celebrities. We've got Mariah Carey on the left, Jennifer Lopez, aka J-Lo, in the middle, and Troy Polamalu, formerly of the Pittsburgh Steelers, on the right. And the reason why we have these folks listed here is that they are all great examples of folks who have what I consider unusual insurance coverage. And because a sizable portion of their income is tied to a certain body part, they each have insurance to protect against the potential lost income if something bad were to happen to their respective body part. And I first want to ask, who do you think of these three folks actually insured their hair? So one of these three people insured their hair because actually they had a contract with Head and Shoulders. And so it was Troy Polamalu there on the right-hand side. So he had a contract, like I said, with Head and Shoulders, where he did commercials and had a pretty good income that came from that. So he the insured his hair in the event of something bad happening to his hair and losing out on that stream of income. Now, I also mentioned that the other two also insured body parts. So Mariah insured her legs, and Jennifer insures her rear end. All right. Let's talk a little bit about the purpose of insurance. And it really is, it's about risk management. Right? And the objective of risk management is to choose efficiently among methods of handling risk so as to avoid catastrophic losses. Now, here on this diagram are some key concepts to consider when managing risk. So start with risk avoidance. Risk may be avoided by not engaging in a risky activity, such as don't fly your own airplane or drive a motorcycle, right? Next, you have risk reduction. So reducing risk through safety improvement. You know, fix the loose railing on the stairs at your house. Have fire extinguishers in your house. Living healthier. Wearing a helmet if you do ride a motorcycle, or just in general, wear a helmet at all times. That's a great risk reduction. Next, we have risk retention. So basically, you can the extreme form of risk retention is taking no action, right? Where you just say, you know what, regardless of what happens, I'm just going to take on that risk myself. Some people refer to that as self-insurance. We'll talk a little bit more about that later. But other ways to retain risk is through the use of deductibles, right? So if you think about it, you know, on your homeowner's policy, your auto policy, really any insurance, there's often some form of deductible. And so the higher the deductible, you're retaining more of the risk. And then lastly, what we're going to kind of launch into here is the risk transfer. And that's really the transfer of risk through the use of insurance, right? Where you say, in risk management, the use of insurance really must be justified based on a cost-benefit analysis. So is a low recurring cost, the premium that you pay, is it worth the trade-off to protect against a high yet low probability cost, such as some form of a catastrophe, right? Whether that be death through life insurance or disability, or house fire, and so on. And another key point that I always like to mention is I know firsthand how an individual's personality can also influence an insurance decision. Growing up, my father only ever made one comment when the topic of insurance came up, and that was, insurance companies only insure that they make money. So, needless to say, my dad had a strong negative bias toward insurance. And on the other hand, I have heard my wife say, if there is insurance for it, then I want it. So it's important to not let your own biases cloud good judgment when it comes to proper risk management or an insurance decision. So let's jump right in here to everybody's favorite topic, their own demise or life insurance. So we all understand that life insurance is not for us. Rather, we pay for life insurance to protect our loved ones. Although I guess you could say that I do pay for life insurance in part for my own peace of mind. So in that regard, it is for me. I pay for life insurance to protect my family from the potential risk or catastrophic loss that could befall them if I were to die and my current and future income were to cease. So if you come to the conclusion that you do need some form of life insurance, then really the next two questions are simply how much and what type. And the answers to these questions are, of course, intertwined. The right type of policy will be influenced by the amount of coverage you need and really also for how long, what period of time do you expect to need the coverage. Now, the three biggest variables when determining how much life insurance you need are your income or potential lost income if you were to pass away, any debts that you have, right? So paying off of debts, and then any education funding targets. As a quick aside, some people also get life insurance as a part of their estate planning, right, or to create and leave a legacy. But I'm just going to say that that's for the follow-up webinar, Insurance 201. So as you can see here on the screen, there's kind of a relatively simple sort of calculator. And there's a lot of versions of these online. This just happens to be one that we utilize. And now we're happy to share with anyone who's interested. But it's basically broken out into the three categories that I talked about. So what's your current income level and how many more years do you expect to work? And you just kind of multiply the two together. And that's sort of saying, oh, here's how much potential lost income is at risk if I were to die. Next, you can add in, oh, if I have children and I'm putting money away for college, how much, if I were to die, how much money would I want to sort of put aside as a lump sum to ensure that there's money there for their college, for the college funding goal. And then the third piece is just what's the debts, right? For most folks, you look at, oh, what's the mortgage, and then are there any other personal debts or student loans of your own that you want to kind of say, hey, if something were to happen to me, that my spouse would be debt free, that they could pay that off through the life insurance proceeds. So that's really kind of the three components there, and then you can back out of that. Hey, if you have existing coverage, maybe you have a policy, maybe you have some coverage through work. And that's kind of the general gist of it. Another really kind of simple, back of the envelope way of estimating how much income you need to replace is just take 75%. So let's just say, just using round numbers here, say your income is $100,000 a year. You could just say, hey, take 75% of that, or 75,000, multiply that by the number of years you expect to continue to work, and that can be a pretty good quick estimate of how much insurance you need. And part of the reason why that 75 is we're not just plucking that out of the air is, if you think about it, your income from work is taxable, right? So a portion of that's going to Uncle Sam, but life insurance proceeds come in tax-free. So that's why you don't necessarily need the full 100% replacement of your income. All right. So the next question, after you've kind of got a sense for how much insurance you need, it comes down to what type of policy should you buy. And really kind of on this basic insurance family tree, if you will, at the first level down, the determination or distinction is between temporary or permanent. So term life insurance, I sometimes like to refer to that as renting of life insurance, versus permanent, whereas you're kind of buying something to have coverage for the rest of your life. And so if we start with the term policies, those are generally kind of the simplest and almost always the lowest cost version of life insurance, where you say, hey, I want to have coverage in place for the next 10 years, 20 years, 30 years, right? You can pick, there's different, usually it's in 5-year increments. You can pick a term to say, hey, this aligns with how many years left I have on a mortgage, or how many years my kids are still going to be, minors and in the house and on the family payroll, right? Those are sort of common points of reference, and folks are looking at the period of time they want coverage. So they say, all right, I'm going to get a 20-year term policy. I just pay that, and I pay an annual premium, and then after 20 years, the policy's done. And you say, hey, great. You're just kind of renting the coverage for that period of time to have that peace of mind, knowing, hey, if something happens to me during that period, my family is protected. Term policies, the premiums are typically level, so you'll pay the same annual premium in year 1 that you would in year 20. In the example I gave, there are some versions that are called annual renewable or yearly renewable, where the premium actually goes up a little bit each year as you age. But for the most part, folks get what are considered level premium term life insurance policies. And then on the other side of the table there, you have various forms of permanent life insurance. And there really are a ton of different forms of permanent life insurance. We have just really kind of scraped the surface here with what we have on the screen. But there's a number of different types of universal life policies. There's variable universal life, guaranteed universal life, equity indexed universal life. And then you also have whole life insurance. That's kind of the insurance that's been around, gosh, probably close to 100 years now. Whole life's been around a long time. But one of the distinguishing factors, in addition to the idea of those policies being enforced permanently, right, is you pay that premium. There's also a portion of that premium that goes into like a savings account or an investment account. So whereas with the term life, you pay a premium, that premium just is for the insurance coverage. With the different forms of permanent life, you pay a premium, and a portion of that just goes to the cost of having the insurance coverage, but then a portion of it also goes into some type of like savings account or a cash value investment account. And again, there's lots of different flavors there that you can do. But it's important to keep in mind that if you do have some form of permanent life insurance that has a savings component to it, you're in the habit of, just like if you have a 401k or just other investment accounts, that you review the underlying investments, at least annually, just to make sure that, hey, that the investments are allocated in a way that's appropriate for you. And like I mentioned earlier, and it's worth repeating, you really should sit down with a professional to determine, hey, what is the best form of insurance for you. But one of the other key points, if there's really one point that you walk away with today more than anything else, is if you know you need some life insurance, don't get stuck in what we like to call analysis paralysis, because that's so easy to do. You say, oh gosh, what should I get? There's so many different choices. For a lot of folks, the best first step is to just go get some term coverage in place, right? You need some coverage. If something were to happen to you, your family needs the protection, or if something were to happen to your spouse, you and your family needs protection. Go get some term coverage in force to meet that immediate need. And then you can always reassess and maybe complement it or supplement it with some form of permanent or cash value life insurance. But unless you really know how you're going to do this right away, you go do it. But for a lot of times, we've just seen this in practice. A lot of folks just kind of get stuck and they don't know exactly, I want to make sure I can make the perfect decision. What's the best thing? Don't fall into that trap. All right, so just kind of a few best practices to discuss. Think about and review your needs periodically, at least annually. And it doesn't necessarily need to be a full, super in-depth analysis, but just kind of think, what's changed in my life? Has my family grown, right? Do I have more kids? Or did I get a big raise? And maybe now there's more income to hedge through insurance. Or maybe you bought a bigger house that has a bigger mortgage, right? All these sorts of things. Life happens, right? So your insurance coverage should also evolve with it. John F. Kennedy had a great line. He said, the time to replace the roof is when the sun is shining. And I think that's a great kind of analogy for life insurance, or really any insurance. But think about it, get coverage in place while you're healthy, right? Don't wait until maybe your health status changes, and as a result, the insurance is going to be more expensive, or maybe you're uninsurable completely if something bad comes about. And try to think ahead. Like I said, maybe you expect, we are going to buy a bigger house with a bigger mortgage, or I'm definitely going to be, my income's going to be going up, so to get insurance in place now in anticipation for the future. A couple just sort of simple, but I think really valuable tips also. Before you submit a full application for life insurance, we definitely recommend you do what's called a pre-qualification health questionnaire. So, we have a form of it. Pretty much everybody can do this, where, it's usually a simple sort of 2-page document where you just write down, hey, what's your current health status, right? When was the last time you saw the doctor? Any recent diagnoses? Any medications that you're on? Any planned surgeries? That sort of thing. And then we can have sort of our back office underwriters do a pre-review of it. So before there's a formal application that's submitted, you can get a better sense for, maybe I'm not going to be insurable based on some health thing, or maybe not all carriers actually look at different health issues the same. So it'll help you determine, oh, you know what, you're going to be better off applying to this different carrier based on your health status. So it's just a good sort of preliminary upfront thing to do. And then once you have a policy in force, it's generally advisable to just pay the premium annually, because you have the option. You can pay it monthly, quarterly, semi-annual, but you'll actually save money. You pay less by paying it once a year. I've seen anywhere from like 5 to 10% more that you actually pay out of pocket if you pay it monthly. And then review the beneficiaries, right? So the whole point is to protect your loved ones, right? And so again, life happens. What if you, like I said, maybe your family has grown? What if you've had a divorce, you remarried, right? And review the beneficiary designations to make sure that you have the people designated that you want to get the proceeds if something happens to you. So just a comment here on, a lot of folks have some form of insurance through their employment, which is a great benefit that a lot of employers provide. That usually it's maybe 1 or 2 or sometimes 3 times your salary, and the employer may cover the cost completely of that coverage. But if you think about it, for most people, that's not enough. If we talked earlier, it's really about what's your current income times the number of years you expect to keep working. So unless you don't expect to work more than 3 more years, you're going to need more insurance beyond just what the group or employment coverage is provided to you. Now the question then becomes, well, a lot of employers allow you to buy coverage through the group plan, right? So you want to get an additional amount of coverage above the sort of the free coverage. Or you can go out and sort of shop in the private marketplace. One sort of quick tip there is the group plans through an employer basically assumes that everyone is of average health, and so the pricing is accordingly. So if you are in better than average health, most likely you're going to get better pricing by going out in the private marketplace. If you are sort of below average health, you may end up getting better pricing through the group plan. So just kind of moving on here, let's talk briefly about kind of liability and loss insurance. So these are the coverages that really you're required by law, right, to have auto coverage. If you have any form of mortgage, the mortgage holder is going to require you to have homeowners policy, right? But the other piece here that we want to touch on briefly, you're not required to have, but we recommend a lot of folks consider getting, is umbrella coverage. And so really it's as the name implies, it's coverage that goes above and beyond your homeowners and auto policy. So just kind of use a simple example, and this is getting a little bit dated, but back in the day when Michael Jordan was playing for the Wizards, we used to joke that if you got in a car accident and you injured Michael Jordan and he was unable to keep playing basketball, then your auto coverage is going to pay out at its limit, and then any additional liability is going to sort of come out of your assets. So that's where the umbrella policy comes in and can provide that additional leverage of liability protection, whether it's something that happened at your home or like I said, with an auto accident. The umbrella policy is going to require certain levels of coverage on the 2 underlying policies, and it's generally pretty inexpensive, in the hundreds of dollars a year premium, but it will definitely jump up if you have kids that they turn 16 and they're on the auto policy, just because the odds of something happening go up. So just like your auto coverage goes up, the umbrella policy is more expensive too. Now, and again, good to review periodically, determine how much coverage you actually need, right? So if you have an older car, right, a car that's paid off, maybe it's not worth a whole lot, double check to see, oh, maybe I don't need full coverage on that older car, right? Just have liability protection on it. Periodically shop it around. You're almost always going to get a better pricing if you bundle, so sort of the home, auto, and umbrella all with one carrier. And then one thing that we often see overlooked with auto coverage is uninsured motorist coverage. So basically that means that if someone else causes the accident, but they have minimal coverage or no coverage, sufficient to cover the cost of repairs or injuries to you, that's where the uninsured motorist coverage kicks in. It's coverage you have to protect against being hit by someone who does not have sufficient coverage. All right, let's talk a little bit about disability insurance. So it's similar to life insurance. Disability insurance protects you and your family from a potential catastrophic loss if you were to become disabled and your income is reduced or goes away entirely. Now, if you don't have disability insurance and you become disabled, then you risk making a difficult situation even more difficult. And I've been known to say that disability insurance may be even more important than life insurance. Now, I will hedge that comment and say that both are important. However, the reason why I sometimes say disability insurance is more important is because, and just to be blunt here, if my income is lost due to death, I'm no longer around and no longer an expense for my family. But if my income is lost due to my disability, I'm still around and I'm an expense to my family. And so that's kind of the rationale in my head where I feel like disability insurance is just super important. And disability insurance is typically limited to replacing no more than 60% of your normal earnings. And it'll oftentimes have a cap where it might say, up to a certain monthly dollar amount. And the benefits are triggered when you meet the contract policy's definition of disability. And so there's really kind of, two primary forms, short-term and long-term. And as the name implies, short-term coverage basically says, hey, if you're in an accident, you break your leg, water skiing, that sort of thing, where, hey, you're just going to be out of work for a few months, typically under 6 months. That's where the short-term disability policy will kick in and pay benefits to help replace lost income during that shorter period of time. The longer-term or long-term disability benefits are, just as the name implies, basically 6 months or longer, where if you're kind of permanently disabled and you're not able to go back to work and you need to replace that lost income. And so for some folks, short-term disability, they may say, hey, I'm going to retain that risk. I've been able to save. I've got money put aside in an emergency fund where if I were disabled for a handful of months, I could cover that through my savings. And they may just say, I'm just gonna, as they say, self-insure that risk, but pay the premium to have disability or long-term disability in force. And just kind of a quick note here on Social Security disability. Some folks kind of get a little confused there, where in reality, that's not something you can bank on. It is an extremely difficult criteria to qualify, and so don't count on Social Security disability. You really need to have your own coverage. And now, I'm actually going to come back to the best practices. I just want to talk first here on the disability through and the employer. So similar to life insurance, a lot of employers will provide some form of disability coverage. If they provide short-term coverage at no cost, great. Obviously you're going to take that. But then some employers will provide some form of long-term at no cost. But a lot of times, just like with life insurance, that may not be enough. And so you want to go out and supplement it through paying of your own disability insurance. And one key difference to keep in mind is the taxation of these benefits. So depending on who pays the premium. So in the example where an employer is providing the disability coverage, and if you were to go on claim and receive benefits, those benefits are going to be taxable to you because you didn't pay the premium. Versus if you have a private policy where you pay the premium, and if you go out on claim and receive benefits, then those benefits are not going to be taxable to you. It's just an important note to keep in mind. And then just the best practices, some notes here. A lot of things that are similar to life insurance, but one that I want to point out is as you get older, closer to retirement, Oftentimes, long-term disability policy, the contract will say it will only pay to age 65 or maybe age 67 at the latest. A lot of them are just to age 65. So let's just say, for example, you're already in your 60s, and maybe you've got money saved up, and you're debating, do I really need this long-term disability? Because even if I went out on disability, the most it's going to pay is just maybe a year or two, and you might just say, hey, as I get closer to that age 65, maybe you can afford to retain the risk, and you drop the long-term disability policy, right? So all things that go into kind of the annual review of, hey, what kinds of insurance do I need? How much do I need? And in some cases, is it appropriate to reduce or drop coverages? So that's all part of the review with going through that with a professional. All right, so the fourth form of insurance we're going to talk a little bit about today is long-term care insurance. So I mentioned earlier that I was just going to talk briefly kind of about health insurance and how it relates to long-term care. The important thing to just kind of keep in mind is they're different. Healthcare and long-term care, health insurance and long-term care insurance, all different things and cover different items. So the best thing that I like to point out is, so the final bullet point you see on this screen is you see Medicare. Right? So Medicare is the primary form of health insurance for retirees here in the U.S. And a real common misconception is that people think that Medicare will pay for long-term care expenses. And just one thing to remember is it does not. Just period, end of story. Medicare may pay for up to 100 days of rehab, right? So if if you're over age 65, you're on Medicare and you have an injury and where you're going to get better, okay, well, Medicare will help pay for that, because the key is it's still looked at as health care because you're expected to get better. But if that injury is something where a doctor says, even after 20 days, the doctor says, sorry, no, the diagnosis here is that you're not going to get better from this. Now it's just maintenance or custodial care. The Medicare, the health insurance component, will stop at that point, and now it becomes long-term care. And if you don't have long-term care insurance, the expenses related to your maintenance at that point, you basically have to either pay out of pocket, or kind of the sad reality for most people in this country is that care is provided from a loved one. Oftentimes it's a spouse or a child, and the data shows us, and we've seen this in personal experience with clients and family, that it oftentimes falls on the shoulder of the oldest living daughter, who is oftentimes live nearest to the parents, and so it can really provide not only a financial burden, but an emotional and just kind of a physical burden on family members. And so that's where people say, hey, I want to hedge that risk and get some form of long-term care insurance. And so that coverage will, if you think about it, it's to provide for care in your own home, it's to provide for care in an assisted living facility, or to provide for care in a nursing home. And just a quick overview on this slide, the long-term care insurance policy kind of has 5 key components to it. One is the benefit amount. Oftentimes it's expressed in a daily or monthly benefit amount. Then there's a benefit period, which is usually referenced by a number of years or number of months. Then there's an inflation protection, right? Because let's just say you're getting a policy when you're 65, odds are you're not going to need it for another 15, 20 years or so. So the cost of care continues to go up, so you want to have an inflation protection to increase your benefit amount over time. Another key component is the elimination period. Think of that as kind of like the deductible, where you can get a policy where you have a 0-day elimination period. So if you go on claim, you need care, the policy kicks in at day 1. But a lot of times folks will get a 30-day or 60-day, or probably the most common is a 90-day elimination period. And then the ways in which you qualify for benefits really breaks down into kind of two categories. One is through physical ailments, and they're referred to as needing assistance with activities of daily living. So it's any 2 of 6 activities of daily living. If you need help with any 2 of those, and really, I always kind of think about it as, think of the first 6 things you do when you get up in the morning: getting yourself in and out of bed, maintaining continence, using the toilet, cleaning yourself, clothing yourself, and feeding yourself. So if you get to a point where you ever need help with any 2 of those 6 activities of daily living, that's when a long-term care insurance policy kicks in. Alternatively, are cognitive impairment. So think Alzheimer's, dementia, right? If you need assistance because of a cognitive impairment, that's also where a policy will kick in. I mentioned a moment ago about the coverage will help pay for care in your own home, in assisted living, or a nursing home. And here it kind of gives you an idea for the DC metropolitan area what the cost of those different kinds of care are. And also you see there sort of in green the 5-year annual inflation, how much that has gone up over the previous 5 years. And that's why it's important to have some kind of inflation protection built into a long-term care insurance policy. And for a lot of folks, just kind of a tip here from experience, when if you're getting serious and you're shopping and you're looking at a long-term care insurance policy, the policies are not cheap, as you're going to see here on the next slide. Actually, here, let me just jump here a little bit. So this kind of gives you an idea of how much, if you were to get what are kind of considered the traditional policies where you pay the premium every month or every year, right? They're not cheap. And typically, most folks, they say, I'm going to get a policy that is a hedge against the cost of care. So usually we'll see folks get, hey, I want a policy that's going to cover the cost of care in my own home, that's going to cover the cost of care of assisted living, but then it's a hedge against a portion, maybe up to half of what I expect the cost of care in a nursing home, right? Because that's because you're trying to strike a balance of between a meaningful benefit level, but also affordability in terms of premium. And so that's kind of what we've modeled here on this screen, kind of give you just a little bit of a flavor for here in the DC area for a single male, a single female, or a married couple. And then a quick comment, for married couples, if you both qualify and you get a policy, you can get what are actually called shared benefit policies, where if one of you used up all of the benefits in your own policy, you can actually tap into your spouse's benefits. So it adds a little bit of flexibility. So I know this is a lot of information to take in. Just kind of wanted to hit on the highlights here to help you sort of figure out, is this something I want to think about? We even have kids say, gosh, my parents, I think, really need to talk about this. So this is something where, whether it be life insurance, disability, long-term care, you name it, I'm more than happy to hop on a call with somebody and just sort of, spend a few minutes thinking through your scenario to say, oh yeah, it makes sense for you to now go take the next step, dig a little deeper. So we've done worked with a lot of clients over the years in many different scenarios where we have a pretty good sense for, oh yeah, this is the right time for you to consider these kinds of coverage, and kind of help you sort of get through that initial inertia, if you will, because I know that's something I struggle with at times with decisions in my own life. The slide I skipped over here was just something I talked about before, sort of the 2 different kinds of care. So now I know we're kind of coming up on our time. So here for long-term care, similar kind of best practices. You can get a discount for married couples I talked about. Yeah, I think I already kind of hit on all of these points. Similar, some employers, it's not as common as life insurance and disability, but some employers do provide some kind of long-term care insurance coverage. For federal employees, you can buy a policy through the federal plan, but really it's just a matter of, you got to compare it to the other private policies, because there's usually not any kind of discount through the federal plan. But we have seen some instances where that plan is better and sometimes where it's not. It really just does come down to shopping around. I probably don't need to really sort of belabor this. I think I've really talked about the notion of risk retention, or what a lot of people refer to as self-insurance, where basically you're just saying, hey, I've built up the savings. I can afford to not have short-term disability, for example, right? Or I can afford to have a high deductible on my homeowner's policy or my auto policy because I've to a point where I've built up my savings. Where if you're younger and still building up those savings, you might need to maintain a lower deductible because you can just afford the higher monthly premium. So, like I said before, the most important thing is take action, right? If you think, yeah, I need some coverage, keep it simple, right? And don't get stuck in analysis paralysis, right? And just go, hey, what is my risk? What's the kind of insurance that can help me mitigate that risk, and what can I afford, and get it in place, right? I went really fast and skimmed over a lot of things here, but really, if there's one thing I want everybody to take home is you've got to plan ahead. You need to think through, work with a professional. Hey, what do I need? How do I go about getting my core or my primary risks covered, so that you or your family aren't at risk of a catastrophic loss. So this will be a part of the slide deck when we share it. And here's I'll leave this up on the screen here for a few minutes. Like I said, I'm more than happy to have a conversation, or on the phone or via email if anybody ever wants to kind of think through your own scenario. We did get a question or two come through. Let me just double check these, make sure we answer them. Sorry, I'm just reading through the question here. Will my premiums increase once I retire? I'm not quite sure which form of insurance you're talking about, but we can, retirement doesn't necessarily, distinguish that premium is going to go up for any form of insurance. A lot of times, keep in mind, if you retire or even just change employment, this is actually a really good point. Might be what you're referring to is so if you have some form of employer provided coverage, whether it be life or disability, you need to think through, what if I change jobs and a new job doesn't provide that coverage? Or what if I retire and I still think I want to have some life insurance, for example? Well, that's something you need to think ahead and go out and get private coverage to ensure that that's something you're going to be able to have in retirement. Now, a great example with life insurance, some employer plans will be what are called portable, where you can take them with you, and you could pay the premiums once you retire. But in almost every instance, those group coverages, the premium is going to go up every year thereafter. And with a lot of times, those plans are designed to really become unaffordable pretty quickly. To perhaps the core of the question is, yes, the premiums for life insurance oftentimes will definitely go up if you have coverage through your employer. So great. I appreciate everybody's time today. And like I said, we will have a recording of this available, as well as the slides if anyone is interested. So have a great day. Thanks, everyone.